Silver has already snapped. Most people just haven't noticed. Here's the contradiction that should stop you cold. On Western trading screens, silver still looks priced, stable, controlled, but at the exact same moment in China, buyers are paying over $100 an ounce for physical silver, in some cases as high as $114. That's not a rumor. That's a live market signal. And the gap between those prices and US futures is now more than $11 wide. In a real market, that gap cannot exist. It would be erased instantly, yet it's still there, growing, which means price discovery has already broken, just not where most people are looking. If you save money, invest, or assume the number on a screen equals something you can actually get, this matters to you. Because this isn't about silver going up, it's about whether markets still deliver what they promise. Western exchanges are quoting one reality. Eastern buyers are paying another, and the metal is flowing in only one direction. But here's the part nobody is saying out loud. If this split doesn't close soon, the system that pretends both prices are real cannot survive intact, and the first stress fractures are already visible. What you're looking at isn't a one-off spike or a quirky regional anomaly. It's part of a larger pattern that's been building quietly, then all at once. The official story says silver is trading normally just with volatility, but the actual event is more specific. Physical silver in the East is being bid aggressively, while the West is still pricing silver through paper contracts that don't require delivery. That distinction matters, because futures prices only work if they can be converted into real metal, and right now that conversion is exactly where the pressure is forming. The widening gap tells you buyers aren't trusting paper claims anymore. They want bars, coins, inventory they can actually touch. Notice what's missing from the mainstream coverage. No one is asking why arbitrage isn't fixing this. No one is explaining why metal isn't rushing from west to east to close the spread. In a functioning system, that flow would be automatic. So here's the question that reframes everything. If silver is supposedly abundant and well supplied, why are two global markets suddenly acting like they're trading different assets? Because once that question lands, the rest of the story moves very fast. Here's the claim that makes people uncomfortable. This isn't a pricing anomaly. It's a failure of physical control. Look at the concrete detail that exposes it. On the Shanghai Futures Exchange, silver trades above $100 an ounce, with transactions reported as high as 114. At the same time, US prices on COMEX lag more than $11 behind. Fact, the content describes this as physical stress, where the East is bidding for real metal while the West leans on paper contracts. That phrase matters because it describes a system under strain, not a market imbalance. In a functioning global market, arbitrage would erase that gap instantly. Traders would buy low in the West, ship metal east, and lock in risk-free profit. But that isn't happening, not at scale, which implies something simple and dangerous. The metal either can't move or doesn't exist in the quantities the paper market claims. Now notice what's missing. There's no rush of physical silver leaving Western vaults. There's no flood of inventory calming prices in Asia. Instead, the gap persists. That tells you the Western price is no longer anchored to deliverable supply. This is where the story flips. Because once price disconnects from delivery, the screen stops being a market and starts being a suggestion. And the next evidence makes that impossible to ignore. Once that anchor slips, escalation is automatic. What should be a temporary imbalance starts behaving like a structural break. The longer the price gap holds, the more it normalizes something that should never be normal. Two global prices for the same metal, with no mechanism pulling them back together. This isn't the first time a market has tried to survive that way. When confidence breaks, systems don't collapse instantly. They stretch, they improvise, they pretend nothing is wrong. That's what escalation looks like here. Western exchanges continue operating as if paper liquidity is the same as metal liquidity. Contracts trade, volumes look healthy, but underneath, the assumption that delivery is always possible quietly erodes. What used to be an exception becomes routine, physical settlement becomes discouraged, delays get explained away, rules get adjusted. Now watch how fast this escalates. The very tools designed to stabilize markets start being used to slow demand instead of match supply. Pricing stops reflecting abundance and starts reflecting stress management. And once that happens, price is no longer discovery. It's containment. This is how broken systems survive longer than they should. By normalizing workarounds, by training participants to accept less, wait longer, or take substitutes. And that normalization sets up the next move, one that forces everyone to choose between paper and metal. Here's where the evidence gets harder to ignore, because it shows up in actions, not explanations. A US government institution quietly stopped selling silver products altogether. The official reason was procedural, a need to reassess pricing. But the behavior tells a clearer story. Prices were moving so fast that the system responsible for selling physical silver couldn't adjust without taking losses. When a national mint pauses sales in a rising market, it's not caution, it's exposure. At the same time, private wholesalers made a choice that would have sounded absurd just months ago. Some preferred to melt existing products rather than sell them at posted prices. That's a direct contradiction. Publicly, silver is available. Privately, it's being pulled off the market. Notice what they didn't deny. No one said supply was plentiful. No one said inventories were comfortable. They only talked about timing and pricing mechanics. This is the line that permanently changes how you see the situation. When institutions stop selling and private dealers stop offering, the market isn't overheated. It's fractured. Paper prices can still print, screens can still update, but physical silver is behaving like something that's already been reclassified, not as a commodity, but as something too valuable to let go. And once that mindset spreads, the next phase accelerates fast. Now the pressure spills into public view. Retail demand doesn't usually break markets. It follows them, but this time it arrived at the same moment. Supply was pulling back. Large retailers began limiting how much silver any single customer could buy. One transaction per member, tight quantity caps per day. Not because of policy, because inventory couldn't keep up. Specialty dealers started posting warnings instead of prices. Shipping delays stretched out, back orders became normal, premiums widened, and something subtle but important shifted. Buyers stopped acting like traders and started acting like holders. They weren't waiting for pullbacks, they were clearing shelves. This is where the story speeds up. When everyday buyers start treating metal as something you secure, not flip, velocity collapses. Metal leaves circulation, secondary supply dries up, and no amount of paper volume can replace that. What happens if this continues? Futures markets can trade endlessly without moving a single ounce. Retail channels can ration without ever saying the word shortage. But once enough people decide that possession matters more than price, the system loses its release valve. And when that valve locks, the next response doesn't come from consumers. It comes from the exchanges themselves. Now bring it back to you, because this is where it stops being abstract. If you've ever assumed that markets work because someone somewhere has to deliver, this changes that assumption. You don't need to trade silver to feel the effect. The same system prices your savings, your retirement account, and the currency you're paid in. When physical supply stops responding to price, confidence is what fills the gap, and confidence is fragile. Think about what happens in real life. You go to buy something that used to be available. It's delayed, limited, repriced overnight, not because demand exploded, but because supply quietly stepped back. That's not theory. That's how breakdowns actually show up. This is why people aren't asking whether silver is expensive. They're asking whether it will be available at all. The mindset has flipped from, is this a good trade, to, do I still trust access later? If this feels familiar, say so in the comments. Because many people have already lived through this pattern, just in different markets with different labels, and once enough people recognize that pattern, the story stops being about one metal. It becomes about how systems really fail. What allows this to happen isn't chaos, it's structure. Modern markets are built on leverage, not inventory. Paper claims multiply because they're efficient, liquid, and profitable, as long as no one asks for everything at once. The system works by encouraging participation while quietly discouraging delivery. Cash settlement, delays, rule changes, all perfectly legal, all designed to keep the machine moving. Here's the unsettling insight. The system doesn't need to be honest. It just needs to be trusted, and trust is maintained through familiarity, speed, and spectacle. Numbers update instantly, trades clear smoothly, screens stay green. As long as that performance continues, most people never test the edge, but physical stress breaks that illusion. It exposes the incentive mismatch. Those who control pricing benefit from stability. Those who need the asset benefit from possession. When those goals diverge, the rules start bending, not to reveal truth, but to preserve order. This is why the response isn't transparency, it's management. Contain volatility, slow exits, redirect demand, because once enough people understand that paper is a promise and metal is final, the system can't scale honesty fast enough to keep up, and that realization is spreading faster than the rules can adjust. From here, the path forward splits, not cleanly but decisively. One path looks controlled on the surface. Prices stay volatile but contained. Paper markets continue functioning. Rules are adjusted quietly. Settlement terms get softer. Cash becomes an acceptable substitute. In that version, the system survives, but only by redefining what participation means. You can trade, you can speculate, but access to real metal becomes conditional, slower, and increasingly expensive. The other path is messier. Physical demand keeps pulling metal out faster than confidence can replace it. Industrial buyers bypass exchanges, retail supply thins further. At some point, paper prices stop leading and start chasing. Not because anyone declared a failure, but because behavior made it obvious. Neither outcome arrives with an announcement. They arrive through momentum, through small decisions that add up, through delays that don't reverse, through premiums that don't compress. And here's the part that matters. The next move isn't theoretical. It's already forming, driven by whoever needs silver the most and can't afford to wait. Which means the real question isn't which path happens. It's how far along we already are. There's one insight that reframes everything you've just heard. This isn't a story about silver becoming valuable. It's a story about promises losing credibility. When a system runs on claims instead of custody, the moment delivery is questioned, value has to be rediscovered somewhere else, and that rediscovery never happens quietly. Two prices for the same thing isn't a glitch, it's a signal. It means the market is already voting with its actions, even if the language hasn't caught up yet. Screens can quote stability, rules can enforce order, but metal moves only when someone is willing to part with it, and that willingness is disappearing. What comes next won't be decided by headlines or commentary. It will be decided by who holds what when the system finally has to reconcile paper with reality. This is just the first layer of that process. If you want to understand how far this goes, how other assets follow the same pattern, and what happens when trust finally runs out, follow the channel. Because this story doesn't end with silver, it starts there.